Basically, they introduced a further degree of centralization in order to add a degree of efficiency to the system. And so, if you go back long enough, people were trading physical gold and silver coins with each other. Then they graduate to banknotes and other types of paper instruments where they're still fairly private and they're sound and they're backed, but they rely on a counterparty to actually have the gold, or at least most of it. And then over time, that naturally results in problems where if the underlying is slower and people rarely want to withdraw it, the people managing those custodians and those banking arrangements are going to realize that. So they're going to say, well, if never any more than 40% of people want their gold back at a time, I can lend the other 60% out. And so they can start making more and more claims for the gold and silver than there actually is gold and silver. And the problem is that, back in that era, like the free banking era, if banks run into a problem, the claims collapse down towards the underlying gold and silver. And that kept happening enough that they said, okay, let's set up a central bank. All banks will store the reserves in the central bank. The central bank will hold the gold, and it has flexibility with the base layer to bail out banks when they need it.